What is going on, everybody? It's Alex here with another video. So behind me we have Jerome Powell, our sugar daddy that prints the money, Janet Yellen, and the stock market, okay? And here is what I want to tell you. I want to tell you something that I really hope you understand and that sticks with you. And I want you to stick until the end so you guys understand what I'm about to tell you, because it's going to make the difference between you making a ton of money in the stock market or like being crushed by it. And we have to learn from our past. If we do not learn from our past, the big issue is that we're gonna make the same mistakes in the future. You know, some financial advisors like to say all the time that past performance doesn't guarantee future returns. Sure, but we can learn from the past. But before I tell you, I wanna remind you to smash that like button, since we have our dedicated Tesla Cyberway soul. That if you haven't seen that video, it's right up there. But in all seriousness, guys, I hope you guys watch this until the end and you try to understand it, because it's important information. Now, like I said in one of my previous videos, once the third interest rate increase happens, we are in trouble. And today I have built my case to present to you why you should be very careful once they raise the rates for the third time. Here's what I want to tell you. On December 14th, 2021, Jerome Powell said that by March they're gonna stop purchasing bonds. And then, because it doesn't make sense for them to keep purchasing bonds and then raise interest rates. So they're gonna stop purchasing bonds by March, and then by June they're gonna have their first interest rate increase happen, the Fed fund rate increase happen. Now, there's gonna be a little bit of a shakedown around March, and then again another shakedown in the stock market around June, and you gotta be careful. But this is not gonna be anything substantial. When is gonna be the substantial crash? We have the past to show us what happened the past crisis. Now, many people think that the past stock market crisis happened in 2008, but we actually had another crisis back in 2018. Let me move back to this screen so you guys can see what I mean. Here is what happened, right? We were going great. We had some shakedowns here. January 2018. You see, like, we had a little bit of a shakedown, which is a big one actually. It's not too. That's a substantial crisis here. They raised the interest rate increase, and I'll show you the correlation here, right? So you see a crash here, another little crash here. We see a steady increase here, and then from here, which is the highest point, the S&P 500 was at 2,800. We went down to 2,600, and then a little bit up, and then another down 2,600, and then we're having a substantial fall to 2416. You guys can see it right here. Like, if you cannot see it, I'm gonna zoom in a little bit more so you guys can see it better. All right. So let's do this one more time now that this is zoomed in a little bit better, so you guys can see what we have here. We were doing great at 2,800. A little bit of a fall at 2,600 around February, another hike right up to March 2,700, another fall 2,600, and then another steady growth here. We had a little bit of a shakedown here, and then from here, September 21st 2018, remember this date, well, we're at all-time high right here. You can see that 2,900 S&P 500. 2,900, we start rolling downwards and we go down to 2,700, and then our lowest point, which is a crucial date, December 21st 2018, you can see it was 2,400. Okay, so what the heck happened between here and there? That's the latest crisis. If you guys are looking here, this is what happened during coronavirus. So forget that. That's a very substantial crash. What happened here? Well, these guys from the Balance, they actually put this together for us. We see what we can learn from that, from these two guys. Janet Yellen has been the Fed of the chair before, now Jerome Powell. So, Janet Yellen, the lady on my right, okay? Janet Yellen, what has she done? And she actually did a very good job. Well, forget about 2016, let's go in 2017, 2018, okay? 2017, we have March 16, 2017, interest rate is 1%, 125, 1.5. Nobody cares. It's been very low for very long, because 2008, if you go back here, I want to give you some context, because why not? The Fed kept the rate at zero between 2008 and 2015, and the recession ended, although the recession ended in 2009, they kept the rates at effectively zero. You can see effectively zero for the next 7 years. So any kind of interest rate happening that after 7-8 years. So March 16th, 1%, is the Fed fund rate, okay? And then June 15th, 125. it seems that we are getting a little bit impatient because we've been to zeros for so long. So we go from 1% to 1.25 to 1.5, and you know, we get 4.1%. That's in 2017. Unemployment was 4.1%. The inflation was 2.1%. Now here's where the meat is, right? March 22. Remember this date. First of all, here is Janet Yellen. Here, our friend Jerome Powell takes over, right? Jerome Powell takes over in 2018, and he did a good job, but in the beginning he didn't get this right, okay? So 2018, let's zoom in here, guys, okay? Let's make this nice and big. So March 22, 175 is the interest rate. Let's see, did anything happen in the stock market in March 22? So let's go March 22 here. Okay, you see? Can you guys see the correlation? It's insane. I want to show you. So here, I'll go back to explain what happened here, but we are right here, March, what do we say? March 22. What happened here, guys? March 20, March 16, March 23. Can you see that? March 22, they raised the interest rates, crash. March 22, they raised the interest rates, crash. It's unbelievable. I'm gonna try and zoom in even more so you guys. It's insane. It is truly insane. And now that's a small crash, and it's gonna happen. But that's the first interest rate, okay? It's a tiny little dip. But this one over here, we're gonna talk about, okay? I'm gonna go back here so you guys can see the correlation. They made the interest rates 175, March 22nd. Let me look a little bit backwards here to see what happened here, because that's a substantial crash, even more substantial than the other one. So January 26, 2018. What happened in January 26, 2018, guys? Can you guys see? December 14th, they raised the rates, and then December 14th, they raised the rates, and then within a month, we have an amazing crash. It's crazy. December 14th, they raised the rates. December 15th, they raised the rates. We have a rally, and then it's inevitable it's gonna crash. January 26th is crashing. Did anything happen? Well, this is explained, and it's always gonna be explained, because you know that Fed chair is being changed. That's why we had this kind of conversation if Jerome Powell is going to be replaced by Joe Biden now, but he didn't, thank God. We changed Fed hands. So what happened here? Let me explain to you what happened here. We changed Fed hands. Fed chair changed from this lady to this guy, and this is this crash. So now we're trying to figure out this guy and see what we're going to do with the economy, you know? Are we sure he's going to handle it well? And like I just showed you, this is what happened in March. Now, he kept raising it from March to June, 3 months. He went from 175 to 2% interest rates from March to June, okay? Now, nobody really cared, you know, up until you can see June, okay? We had a small one, like again, you can see it again right here, tiny one, okay? So first, let me see the strikes. So how many strikes? One strike here, June 14th, first interest rate. That's what I feel we're gonna be this June. September 27, second interest rate. September 27, second interest rate. September 27, there you go. September 27. I hope you guys understand what I'm telling you right now. September 27, 2018, right this very moment. I'm gonna go to the next day, Okay, September 27, he decided to increase the interest rates for the second time. And we're rolling backwards and backwards and backwards. And it's a little bit of a shakedown, and you can see it from the time he raised the interest rates up until October 26th, we have another drop. And this is the second strike, okay? I'll go right here. Second strike. First strike is right here. Second strike is right here. Now, Jerome Powell just took over in 2018. He raised the interest rates once. Everybody kind of cared. He raised the interest rates for the second time. And this doesn't really matter, like I said, because he took over. So 1, 2. Now let's see what happened the third time he raised the interest rates. And I'm gonna go back to the other screen, but let me show you here. Look at this. They promised to stop raising interest rates. They promised to stop raising interest rates because they knew they're gonna collapse the market again. This is the correlation between the Fed raising rates and the crashing in the stock market. Okay, I'm gonna go back to here, December 20th, 2018. Let's go back. December 20th, 2018. November was bad, and then we have this downward trajectory that they were expecting it, and then December 20th, right here, boom, December 20th. So December 21st, we cannot get any further here, but December 21st is the lowest point. December 21st, 2018 is the lowest point because December 20th, like I said, the Fed decided to raise the interest rates for the third time. The worst thing they did is they waited 3 months from September to December to raise the interest rates. So they promised to stop raising interest rates. This is the biggest crash we've seen up until 2020. Look at it. That's the biggest crash we've seen. The same thing is gonna happen this time, guys. The same thing will happen this time. The third time they raise the interest rates, not in June, not the second time, but the third time, you need cash on the side to propel you forward. This decade is gonna be great, but you have to be careful because the third interest rate, there's gonna be margin calls happening. The third interest rate, there's gonna be a lot of unwanted things that you have to be on the sidelines with cash on the side. Do not pull your cash on the sidelines yet. Be ready for the third interest rate increase from the Fed and then deploy all your cash on the red days. You know, the thing about the stock market is that it's not like real estate. It's more thinking, learning from the past. In the stock market, you really have to understand what is going on, see what's causing things. Irrelevant things may cause irrelevant things to happen to the stocks you like, you know. And you have to accept that, and you have to think and believe and have trust in the stock market. The stock market is not like real estate. Real estate is stable, but the returns in the stock market are way bigger, and then you might lose, so it's more risky as well. What I want you to take away from me, I'm gonna say it one last time. The third time they're gonna raise the interest rates, there is gonna be a lot of trouble happening. Enjoy this next year full of nice returns, then be on the sideline, save your cash, and be ready to deploy and pull the trigger when it matters. I love you guys so much. Thank you for watching. I'll blow my whistle one more time. Hope you guys enjoyed this one. Smash the like button down below. Love you guys.